Yeah. Okay. Good morning. Today we're starting Chapter 9. Before we go any further, I want to tell you I do not feel well today. So I'm going to go as far as I can, but we may end class rather abruptly. So I apologize ahead of time. So we'll go as far as we can and be done with it. Starting with what to do this weekend, we have an attendance quiz that's due Saturday. That attendance quiz will be available today, probably around 1 o'clock. It will only cover stuff from Tuesday this week. We'll just do it that way, so however much we get through, we're good. Chapter 8 homework in my accounting lab. Remember, this is the littlest homework, one of the shortest homeworks of the semester, and then video quiz 19 over Chapter 9 videos in Blackboard. So that's what's due coming up. Again, I want to urge you to go to tutoring. There is tutoring today, so if you check your email, there's times and you can still sign up now. Also, watch this weekend, Sunday or Monday. I'll send out tutoring sign-ups, probably Saturday or Sunday, maybe even Friday for next week. So do watch for that. We have tutoring Monday through Thursday. And if you want to see your exam, Brian's available today from 1 to 2. If we land in class early, he's also available during our class time, room 579. Okay, so you can just stop by to see him. And today we're talking about Chapter 9. Chapter 9, up to this point we've done our assets. We started with cash, we went to accounts receivable, property, plant, and equipment, investments, and now we're through the assets and now we're on to liabilities, which is the next section of the balance sheet. So in this chapter, there are 5 learning objectives in the book. We're covering 4 of them. So one of the learning objectives is not covered. It won't be in the videos you watch for Chapter 9. It won't be in the lecture, and it will load eventually here. There we go. Okay, so we're not covering learning objective 3. And this chapter is not bad. It's not terribly long. And we are going to be a little bit ahead on the syllabus for a few days, and that's good because we've got a lot of chapters, so that will ebb and flow. Okay, so we're going to start talking about liabilities, starting with current and contingent liabilities. There we go. So talking about a contingent liability. A contingent liability is a liability that depends on some future outcome from the past. Now there's a really, really good example of a contingent liability in the news for the last few months, and some of you may be impacted by it. Target's data breach, if you went to Target during that time, which I did, and the hacker stole the credit card information of Target customers. Target has a contingent liability arising from that event. And what that means is they've got to recognize a liability in their books if certain conditions are met. Now, Target has 3 groups of liabilities that they talk about. Okay, so here's the criteria for contingent liability. Remember, contingent liability depends on some future event based on a past outcome, a past event. So thinking about Target, they have to accrue for a liability. They have to set up a contingent liability if the loss is probable and they can estimate the amount. And they disclose it if the loss is reasonably possible. I'll wait till you write that down, and then I'm going to talk about what Target's doing in these areas. Okay, Target. So Target had this data breach. It occurred in November, and they discovered it later. Well, it occurred in November, and then they discovered it later. So their financial statements for 2013 cut off at the end of December. They have a 10-K filed with the SEC. And if you look at that 10-K, there's a section in it for contingent liabilities. And you see that they acknowledge that there's 3 groups of expenses associated with this data breach. The first group of expenses that Target has is the cost to replace those customers' credit cards. I know myself, my credit card company issued me a new credit card a month later. The credit card company is not eating the expense of issuing all those credit cards to customers. So Target has to pay for it. So Target, as of the end of the financial year, they know they're going to have to pay for all those credit card issuances. And that's a pretty easy amount to estimate. So they accrue for the credit card issuance because the loss is probable. They know they're liable to the credit card companies for those the expense of replacing your credit card. And they also know about how much that's going to cost. So Target accrued in 2013 for the liability for replacing credit cards for to pay the credit card companies. So that's an example of a contingent liability. It's based on a future outcome, meaning the credit card companies are going to come to them and say, pay us for the credit card reissuance costs, and they can estimate the amount. Okay, so that fits that criteria. So they actually have an amount on their income statement for 2013 related to replacing credit cards. Okay? Now, the next category, disclose, loss reasonably possible. Now, Target then goes on to disclose there's another group of expenses. And these expenses with the data breach have to do with covering the credit card company's losses from people that have fraudulently used those credit card numbers. So Target says they acknowledge that it's reasonably possible that they're going to be on the hook for these losses from fraudulent use of the credit card data, but they cannot reasonably estimate the amount. So they disclose it. So in the notes to the financial statements, Target says, we know it's reasonably possible we're going to lose money from people fraudulently using these credit card numbers, but we can't estimate the amount. So that loss is not on their income statement yet. They can't accrue for it because they can't estimate the amount. So they disclose that. Now there's a third group of expenses that Target has, and Target says these are the expenses associated with fines from perhaps the SEC or other regulatory bodies saying that you didn't protect your data, we're going to penalize you. So Target does not feel that that's reasonably possible or probable, but they still go above and beyond and they disclose that that's another far out possibility. So they're treating it even lighter. They don't have to disclose it, sort of, but they are to err on the side of caution. So Target's an excellent example of some contingent liabilities. The ones that they can estimate the amount for, they already are on their income statement. The other ones they're disclosing so that users, when people are looking at buying Target stock, they're certainly looking at the impact of the credit card data breach. Okay, so that's kind of a word about contingent liabilities. Current liabilities are ones we already owe, the debt already exists. So then moving down a little bit on the balance sheet, then we go on to bonds payable. We talked about bonds in terms of an investment. In this chapter we're talking about bonds in terms of a debt. So we issue the bond. This is a way for companies to borrow money. Companies can go to the bank and borrow money. A lot of times the banks aren't big enough to loan the amount of money that the company needs. A lot of times too the bank would charge a way higher interest rate than the market's charging. So banks will say, or companies that are nationally rated, credit rating, can go to the bond market, issue bonds saying, well, it's like a savings bond where they'll say, we'll pay you $1,000 10 years from now, so give us money now. So bonds are sold on the market. They're always sold at the market price, and they're sold at the bond's present value. So we did present value on Tuesday a little bit. Present value is what that $1,000 we're going to get 10 years from now is worth in today's dollars. So we have to take this bond. A bond represents a promise to pay many years out in the future. So when we have a bond, when we figure out what we're willing to pay for it, we have to take the present value of that bond. No one is going to buy a bond for $1,000 to get $1,000 after 10 years. They've got to have something else in it. Okay, so we sell the bonds at market price. The market price is the bond's present value. Now, two interest rates affect that present value and the bond's price. So there's two interest rates we need to worry about. The first one is a stated interest rate, and the next one's the market interest rate. I'm going to let you write this down, and then I'll explain more about it. Yeah, Rhonda, I was in that same boat, my credit card. We have these two rates. So this is important. If I were writing this on my reference sheet, that would be a good idea. I would definitely know there's two interest rates in every bond or many bond problems. The first one is the stated interest rate. A bond will pay interest, and that's also known as its coupon rate. It's what the bond pays. That's set when they print the bond certificate or when they do all the legal stuff to do with the bond. They pick an interest rate. So they say, we're going to have 6% bonds or whatever they are. It's stated on an annual basis. It determines how much cash interest is paid to the bondholders. Now this interest rate is selected maybe a month before the bond issues or a couple months before the bond issues, and the interest rate on the market fluctuates constantly. So, but they can't change the stated rate. The stated rate is set. It's carved in stone. It's how the interest on the bond is calculated. Now, the other rate affecting our bond is the market interest rate. And the market interest rate is what the market is getting paid. So as an investor, if I go to invest my money in a bond, what interest rate am I going to get? And that fluctuates. That can fluctuate minute to minute. It is not fixed. It floats around. So what companies do is they'll go to issue a bond. They'll say, oh, we're going to pay 6% interest on this bond. And then they go to market with their bond a month or two later to sell their bond. So remember, their bond's selling it at 6%. And let's say the market rate is now 8%. Is anyone going to want to buy their bond at all? No, because they're only paying 6%, but the market's paying 8%. So they can't adjust their interest rate, but what they do is they end up adjusting the price of the bond. So we're going to go through that. Okay, the bonds again. Okay, so this is the same as the last slide. It just looks a little different. The stated rate is usually different from the market rate. They are usually different. Okay, so the stated rate and that market rate are usually different. Now we have three possible situations. We can have the stated rate equal the market rate, which happens occasionally. We can have the stated rate be greater than the market rate, or we can have the market rate be greater. This is another thing, definitely. I would be 100% sure to put this on my reference sheet. This right here is going to be able to answer several questions. The first case is when the market rate equals the stated rate, we issue the bonds at par, which means we're going to issue them for exactly their face value. And again, I'll wait for you to quit writing and then I'll talk through the rest of this. First case, case A, stated interest rate equals the market interest rate. Let's say the stated interest rate on our bonds is 6%, so they're paying 6%, and the market rate is exactly 6%. This would be a rare occurrence, but then we would say our bonds are issued at par. At par means 100% of their face value. So if we have a $1,000 bond, if our stated interest rate in the bond is equal to the market rate, then we are going to issue that bond and we will be paid $1,000 for it. Okay? If it pays 6% and the market rate is 6%, the present value of that bond is its face value. Case B, our stated rate is less than our market rate. So this is a case where our bond's paying 6%, let's say the market's paying 8%. Nobody is going to buy our bond if they can go put their money somewhere else and earn the 8%. So what we do instead is we say, wait a minute, buy our bond. We will discount it. We'll give you some money off on the bond. So instead of paying $1,000 for a bond, maybe you pay $900. So you pay $900 for the bond, and then at the end of the bond life, you get $1,000. So the difference between the $900 and the $1,000, that discount that we give, represents additional interest to the buyer. So they add that to the stated rate, the coupon rate that the bond pays, and they're whole with the market rate. So that's case B, issued at a discount, which means less than 100% of face value. So a discount is going to be anything less than 100%, a price less than 100. And then case C, our stated interest rate is greater than our market rate. Let's say our stated rate is 6%, but the market's only paying 2%. So we're paying way more than we need to. So we can command a higher price for our bond. So we would sell our bond instead of at $1,000, maybe we sell it for $1,100. So that's said to be selling at a premium, and that means the price is more than 100% of the face. So those are our three situations we have. We can sell at par, which is 100% of face. We can sell at a discount, which is less than 100%. And then we can sell at a premium, which is greater than 100%.
They would discount it so that the person buying the bond is the investment that they bought on the bond. So,
yeah, well, the question is about the people selling the bond. The market, meaning all the investors, are the ones that set the prices. So the company issuing the bond doesn't have anything to do with what price it sells it at. They go to market. This is all done through brokers and agents. They go to market with their bond offering. They don't know until right when they hit market what the market rate's going to be, because it fluctuates minute to minute. So they go out there, and these huge volume traders who are doing volume trading, they're the ones that have a lot of influence on the price. Those huge volume traders have programs where they put in, they say, oh, this bond has a 6% coupon rate, but the rest of the market, the interest rate's way up here, so they put that in their computer, and their computer spits out the present value of that bond. Well, how does the buyer of the bond know? Yes, so when you go to market, when we talk about the market rate being, say, 8%, that's the market rate for all the bonds of similar risk. So this would be everybody that's rated really high credit-wise would get 8%. If you're not rated as high credit-wise, maybe it pays 10%. So as a buyer, you have some choice there in terms of risk. Do I go for a higher market rate or lower market rate? But within that stratum of everybody selling at that market rate, there will be a little bit of fluctuation due to other factors too. So we might look at a company like Apple and we say, oh, we're going to buy their bond because we have warm, fuzzy feelings, because that does influence it to some extent, their market reputation. But they also might know some things that are going, I mean, just some general marketability of that company might influence person to say, well, we have two bonds paying exactly the same, but I'm still going to pick this one because of other factors. So, but the market, yes, the market rate is meant to equalize it, and if every company were exactly the same, then as an investor, you could roll the die and pick one. But there's a lot of other things that go into it, but this is a big factor. Okay, good question. Okay, and we're going to do a homework problem now. And we're doing short exercise 9-1. Okay, 9-1. We're going to be starting with the homework with a short-term note payable. So we're going back to the top of the liabilities, and then we'll work our way down to bonds. So this is a note payable. A note payable is what you would have if you went to the bank and you said, I want to take out a loan, and the bank makes you sign a piece of paper, a promissory note. That's a note payable. The fact it's a short-term note payable means that it's due within 12 months. So let's see. Gordon Sports Authority purchased inventory costing $11,000 by signing a 12% short-term note payable. So here's an example where they didn't go to a bank, but the vendor who they're buying inventory from is offering financing. So the vendor says, hey, buy our stuff. We'll finance it for you, but you have to pay interest. So they're to sign a short-term note payable, 12%, and then this purchase occurred on July 31st. They pay annual interest every year on July 31st, and then we are writing the journal entries for the purchase of the inventory, accrual of interest expense, and payment of the interest. Okay, and it says round your answers to the nearest whole dollar. So we're going to go through this step by step, starting with entry A. So going back to entry A here. So entry A, purchase of inventory. So our first entry is going to be this Gordon Sports Authority goes out and buys inventory. They told us in that first sentence we bought $11,000 of inventory. So we know right off the bat our journal entry is going to be $11,000 debit and credit by signing a short-term note payable. So in this case, we're getting inventory, so we're going to debit inventory, and we paid for it with a short-term note payable. These journal entries we're doing in this homework problem are pretty good examples. So again, this is something that I would put on my reference sheet. These are pretty good examples. So if you label purchase of inventory journal entry, it will always look like this. We have inventory increasing 11,000. It's an asset, so it goes up as a debit. And account notes payable, short-term notes payable, will increase with the credit, which is what is happening here. That was purchase of inventory, entry A. So then we move on to the next entry, and we have accrual of interest expense. What happens here is they're telling us in entry B that April 30th is the company's year end. So what they did is they took out this short-term note payable on July 31st, 2012. So now time has gone by and it's now April 30th. It's their year end. They're not going to pay the note until July. It's a one-year note. So they're not going to pay the note until July 31st, 2013. But at their year end, they have a year end of April 30th, which is not unusual. They have to accrue for the interest because they have a liability. So that's why this is belonging in this chapter. They have this short-term note payable, which when they signed the note they had that, but now it gave rise to another liability in that they now owe the interest from the time they signed the note on July 31st, 2012 to the end of their financial year, which is April 30th. So what we have to do is we have to accrue the interest for that. So what we're going to do is we're going to be debiting interest expense and crediting interest payable, and how we're going to get that amount. Okay? I'll let you write that down and then I'll talk through it. Okay, let's talk about what is going on in this journal entry. We are at April 30th. It's the end of our fiscal year. So we need to recognize that we owe interest for the period of time we've had this note payable or this loan. So we're recognizing interest expense. That's why we're debiting it. We're crediting interest payable. You may want to label this journal entry in your notes as to accrue interest on a note payable, because this is what it will always look like. You will always debit interest expense, always credit interest payable. If you have to do an accrual entry, even if you can't do the calculation behind it, you'll be able to do interest expense and interest payable, and you've got halfway there. Now, to calculate the amount, we took this loan out on July 31st, 2012. The day you take the loan out doesn't count. We also do it by months unless it's a 12-day note out of 30 or something, but normally we're going to see it out of months here. So we'll have August, September, October, November, December, January, February, March, April, which is 9 months. So we'll do the $11,000 face value of the note times the annual interest rate of 12% times 9 months out of 12. The 9 months represents the number of months we held this note before the end of the year. So as of the end of the year, we owe 9 months of interest on this note, so that's where the $990 came from. Now we'll need this journal entry, I think, in the next journal entry too. So we'll see it again. Now we go on to entry C. Entry C says payment of the note plus interest on July 31st, 2013. So this is a year after we signed the initial note. We're paying the note off. And this entry, I'm going to put it up here. Okay. And again, I'll put it up here. I'll let you write it down, and then we'll talk through where all these numbers come from. On this journal entry, now we'll talk about it. There's 3 debits. You can do those debits in any order you want, but the 3 debits have to be before the credit. And when I would make sure I had this journal entry in my notes. I would put all 4 lines in it, and then I would fill things out by the easiest things first. The easiest thing on this entry is the first one, note payable short-term. Short-term note payable, we're paying off the note payable that we had. We want to pay that original liability off. So that $11,000, that's the face value of the note. That will always be your face value of the note. So that's the easiest number to put down. Okay, now the next number down, interest payable, you may or may not have interest payable. You only have interest payable when you accrued interest like we did on April 30th. So that entry that we just did, we set up a liability saying we are liable for 9 months of interest. So we had an interest payable of $990. So we want to wipe that out as well. So that interest payable is debited for $990. Then we also need to recognize the interest expense from the year end to when we pay the note off. So we had interest for May, June, and July. That was 3 months. So that debit to interest expense is the $11,000 face value of the note times the 12% interest rate times 3 months out of 12. So that's where we get the $330. To get the amount of the cash, yes. If it matured before year end, before you did an accrual, yeah, you would not have the interest payable line at all. Yeah. So if you don't have to do the accrual, which is fairly common, you don't have that interest payable line. So that interest payable line is optional. It only is if you did an accrual. And your cash here, your cash is going to be the face value of the note plus all the interest on the note. So you take the $11,000 times 12%, get that, and that would be $1,320, and you would add that to the $11,000 to get the total cash payout. Because when you pay off a note, you're paying off the face value of the note plus all the interest added together. The reason we only do 3 months of interest expense is because, I'm getting this, Brian, because it's related to what I'm talking about. So we only do 3 months of interest expense because the other 9 months of interest expense was in the prior fiscal year. Their fiscal year ended April 30th. So we put the 9 months of interest in that fiscal year ending April 30th, and then we're going to put 3 months in this new year. Good answer. Okay, the next requirement for this one is show what the company would report on its balance sheet at April 30th and on its income statement for that same year. It'll load, and once it loads, I'll give you a minute to write down, and then we'll talk about why these numbers are like they are. When you're answering this question, when it says show what the company would report on the balance sheet, we're going back. This is where the course is cumulative, even though the like the exam's not cumulative, but this is where you have to think back to earlier material. Think about balance sheet. Balance sheet has assets, liability, and equity accounts. And the equity accounts are common stock and retained earnings, basically. So on the balance sheet, everything that we've done through April 30th, We have a liability for notes payable short-term. That was $11,000. That was from that journal entry we did. And then we had interest payable. So the balance sheet holds assets, liability, and equity accounts. Equity accounts being the stock and the retained earnings. So we pick out our liabilities there. On the income statement holds revenues, expenses, gains, and losses. And our journal entry by April 30th, we had interest expense of $990. So that's identifying what kind of accounts go on those statements. As a note, it's not asked for in the homework, but we purchased inventory costing $11,000. So this homework is focusing on that note payable, and that's what they're looking for. But technically speaking, that inventory is also on the balance sheet as an asset, as a short-term asset, current asset. Yes? How did I get interest expense of $990? If we go back to that second journal entry, because remember they're asking us as of April 30th, and as of April 30th we had to accrue for the 9 months of interest. Okay? So you have to watch the dates because you can get tripped up on the dates pretty easily on these. And I think that we're going to be done today, so that's all right with you. I know it's okay with me. I don't have a choice. So we'll be done for today, and the attendance quiz will be available today by 1-ish and 1 or 2-ish, and it won't have any questions for today on it. So I will see you next week.